Hello and welcome to another session of the My Solo 401k Financial Daily Webinar Series. We're excited to discuss Supercharge Your Retirement, how solopreneurs can contribute to both workplace and solo 401k plans. As always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. Please like and subscribe on our different platforms, whether on YouTube or LinkedIn or X. That way you can get notifications of when we go live. We go live twice per day, once at 10 a.m. Pacific, 1 p.m. Eastern, and then we're back again for our afternoon session, 1 p.m. Pacific, 4 p.m. Eastern. Also, liking helps us to get the word out to other entrepreneurs like you. So we do appreciate the opportunity to discuss these topics. So again, we're here today to discuss Supercharge Your Retirement, how solopreneurs can contribute to both workplace and solo 401k plans. Let's start the conversation with the basics. And of course, we do encourage you to chat over questions or topics that you want to discuss. We love to discuss those questions and topics. So feel free to chat those up, but we'll go through the slides that we wanted to bring and share in the meantime. But yeah, it's good to lay the foundation with some basics. So what is a solo 401k? Who's eligible to set up a solo 401k? Well, like any 401k plan, a solo 401k is for a business, but specifically it's for an owner-only business. So in order to be eligible to set up a plan, the individual needs to be self-employed with no non-owner, non-spouse, full-time W-2 employees working for any business owned by that person or a spouse, if any. Some of the top eligibility considerations include whether or not you need a separate entity, like an LLC or an S Corp. The answer is no. We have many customers who operate without a formal legal entity. They operate as a sole proprietorship. And that's totally fine as long as they're reporting earned self-employment income on their taxes. So that's going to be on Schedule C, for example, if your business is taxed as a sole proprietorship, whether you don't have a formal legal entity and you just receive, say, a 1099 NEC, or whether you have an LLC, but it's a single member LLC. Or it could be W-2 wages, for example, if your business is taxed as an S Corp. There's no minimum amount of earned self-employment income that one needs in order to be eligible to set up a plan. Your spouse or business partner may participate as long as your spouse or business partner are reporting their own earned self-employment income, such as their own W-2 in the case of an S Corp or a C Corp, or their own Schedule C in the case of a business taxed as a sole proprietorship. Now, to today's discussion, right? How you can supercharge your retirement by contributing to both a workplace plan and a solo 401k plan. It's absolutely true. It's very common that individuals will have both a plan through their day job, right? They'll participate in a 401k plan at their day job through their W-2 employer, and then also have a solo 401k for their separate side income, right? It could be a side hustle or a separate business. Right, as we were discussing, right, they don't have to have a formal legal entity, but you can have a solo 401k. The fact that you've got a 401k plan through your day job won't prevent you from setting up a solo 401k for your self-employed business, even if you're, again, participating in that in that day job plan. Now, as we dive deeper, right, into the discussion of supercharging your retirement, how solopreneurs can contribute to both workplace and solo 401k plans, let's continue to lay the foundation with discussing those contribution rules. So anytime we talk about how much you can contribute to your solo 401k plan, it's good to understand that your ability to contribute will depend on different factors, right? One is your self-employment income, another is your age, another is whether you participated in another plan, like a day job plan, and then the type of contributions that you want to make, whether employee versus employer, pre-tax, Roth, or voluntary after tax, right? A solo 401k plan has the highest contribution limits for any defined contribution plan available to self-employed individuals because it does allow for both employee and employer, right? Because when you're self-employed, you're both the employee as well as the employer. And then if you have a plan like ours that allows it, you can make not only pre-tax contributions that reduce your taxable income now for the year for which you make the contribution, but also Roth and even mega backdoor Roth contributions. And I see we got a question. We're going to tackle that question as soon as we go through these slides here. So let's just a few more minutes and to finish these thoughts. So let's now focus on, okay, self-employment income. What is that? Now for today, we want to focus on a business that's taxed as an S Corp or a C Corp. Could be an LLC taxed as an S Corp or a C Corp. We previously have discussed this topic of being able to double up your retirement contributions, contribute to both the workplace plan and a solo 401k plan. We previously discussed this in the context of a solopreneur. So if you go to our YouTube page, for example, you can find the video there. So for today, though, for that business that's taxed as an S Corp or a C Corp, right, one of the factors is self-employment income. Now, what that means depends on how the business is taxed. In the case of a business taxed as an S Corp or a C Corp, that's going to be W-2 wages that you receive from your S Corp or your C Corp. Now, you can't consider W-2 wages from other sources like that day job. You can't consider investment income, such as the income that you receive as the owner of the entity, like a K-1 from your S Corp. So again, based on W-2 wages, not passive income. W-2 wages specifically from your self-employed business. Now, this is a good slide as it gives a good visual representation of how you don't use passive income. It's got to be W-2 wages, specifically box 1 of the W-2 that you receive from your S Corp or C Corp, plus any elective deferrals not in box 1, but over in box 12. So for example, if you are making an employee contribution to your solo 401k on a pre-tax basis, that's going to reduce your taxable income. And mechanically, the way that that's done is it reduces the amount in box 1. So for example, for 2025, if you make a $23,500 employee contribution to the solo 401k as a pre-tax contribution, let's assume your wages were $80,000. Box 1 is not going to be $80,000. It's going to be reduced by $23,500. It's going to be $56,500. And then the $23,500 pre-tax contribution is going to be reported over in box 12 of your W-2. So that way you only transfer over to your 1040 as taxable income, the lower amount, right? $56,500. But for purposes of determining how much you can contribute to the plan, you use the full $80,000, right? Box 1 of the W-2 plus the $23,500 over in box 12. Now, as we continue to lay the foundation with the contribution rules, it's good to understand that there is different limits. So as I mentioned, there's different types of contributions you can make to our solo 401k plan. It could be employee or employer, pre-tax, Roth, or voluntary after tax. So with respect to those different buckets, there's different sublimits. But then we've also got the overall limit. So for 2024, the overall limit is $69,000 plus an additional $7,500 if you're 50 or older. For 2025, the overall limit increased to $70,000. Still an additional $7,500 if you're 50 or older. But now there's the super catch-up contribution amount. So instead of $7,500, if you are age 60 to 63, it's $11,250. for a total of $81,250. So now let's start to look at the different sublimits. That's the overall limit. Now let's look at the different sublimits. So first, let's talk about the employee limit. So the employee limit, also referred to as salary deferrals, is 100% of the W-2 wages from your self-employed business, not to exceed $23,000 for 2024, plus an additional $7,500 if you're age 50 or older. For 2025, the employee limit increased to $23,500. It's still an additional $7,500 if you're age 50 or older. But now, instead of $7,500, if you're age 60 to 63, you can contribute an additional $11,250 for a total of $34,750 for 2025. If you got that self-employment income to justify the contribution, right? because again, it's 100% of the wages. You can't save more than you earn, but you can contribute dollar for dollar up to these amounts. Now, it is going to be reduced by contributions made to another plan, right? So that's what we talk about, supercharging your retirement, how you can contribute to both workplace and solo 401k plans. If you max out to your day job plan, you can't make any more employee contributions to the solo 401k, but making those day job 401k contributions won't reduce your ability to make employer or voluntary after tax. And we're going to talk more about those limits, and then we're going to apply what we've learned to different scenarios so you can really see how it works. So that's that first bullet here. Need to reduce by any contributions made to another plan. So like a day job plan, unless the other plan is a 457 governmental plan. So contributions to a 457 governmental plan are not aggregated. They don't reduce how much you can contribute to the solo 401k. Now, our plan not only allows for employee contributions to be made as pre-tax contributions to reduce your taxable income for the year for which the contribution is made, but also allows for Roth contributions, which are not going to be made on a pre-tax basis. They're not going to reduce your taxable income for the year for which the contribution is made, but you've got that potential for tax-free growth because it's in a Roth account. So if an employee contribution is made as a Roth contribution, it's not going to reduce box one for the year for which the contribution is made. But again, you've got that potential for tax-free growth because it is a Roth contribution. Now, if you're making Roth contributions, they need to be deposited into a separate sub-account. So you might have one account for pre-tax contributions, a second account for Roth contributions. Now let's turn to the limit that applies to employer contributions, also referred to as profit-sharing contributions. Now, the employer contribution limit is a percentage of your self-employment compensation. Remember, for a business taxed as an S Corp or a C Corp, self-employment compensation is the W-2 wages that you receive from the S Corp or the C Corp. Specifically, box one of the W-2, plus any pre-tax elective deferrals not in box one, and instead reported in box 12. So of that amount, you can contribute 25% of your W-2 wages as an employer contribution. Now, you have to keep in mind the overall limit, right? So the total amount of contributions that are made to the plan, whether employee, employer, or voluntary after tax, cannot exceed the lesser of the self-employment compensation or the overall limit, right? $69,000 for 2024, $70,000 for 2025, or higher if your age is 50 or older. Now, unlike the employee contributions, which are reduced by contributions made to another plan, such as a day job 401k plan, the workplace plan, your ability to make employer contributions to the solo 401k is not impacted by contributions made to another plan, like the day job plan, unless those contributions are made to a 403b. So you got the general rule that employer contributions, the limit applies at the employer level. So contributions made to a plan sponsored by an unrelated employer, such as your day job employer, do not reduce one's ability to make solo 401k contributions as employer contributions to the solo 401k plan. That's the general rule. Employer contribution limits apply at the employer level. But an exception to that general rule is the 403b exception. So under that 403b exception, all contributions made to the 403b, whether employee or employer, together with any contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. Now, with Secure Act 2.0, employer contributions can now be made as Roth contributions. But in our experience, based on our experience with our customers and client feedback, it's really not something that a large number of our customers are taking advantage of. Why is that? Well, they already have the ability to make mega backdoor Roth contributions. So if their goal is to make contributions that end up in a Roth account, first of all, they can make mega backdoor Roth contributions, which is really making voluntary after-tax contributions. And voluntary after-tax contributions can be made at a higher percentage, right? You can contribute 100% of your self-employment compensation as a voluntary after-tax contribution, whereas the employer contribution limit, even if you're making Roth contributions, is going to be a percentage of your self-employment compensation, 25%. So one would need 4 times the amount that they want to contribute as a Roth employer contribution in self-employment income to justify that contribution, whereas they would not need as much income because they can contribute 100% as a voluntary after-tax contribution to justify the same contribution being made as a voluntary after-tax account. So you don't need as much income to justify the contributions that you want to make if you just simply make those contributions as after-tax contributions rather than making employer contributions as Roth contributions. Second, from a deadline perspective, there's no difference between making voluntary after-tax contributions and employer contributions as Roth contributions. Lastly, there's more flexibility with respect to voluntary after-tax contributions. So what we mean by that is that one can make voluntary after-tax contributions and then immediately transfer those amounts, those voluntary after-tax funds, out of the plan to a Roth IRA. Whereas if one wants to transfer employer contributions made as Roth contributions out of the plan to a Roth IRA, they would have to meet a triggering event, such as being age 59 and a half or older. So that's what we mean when we say that you have more flexibility with respect to voluntary after-tax contributions. So for all those reasons, in our experience, based on client feedback, customers are not really making a large number of employer contributions as Roth contributions because our plan already allows for mega backdoor Roth contributions. Now, for those that do still want to make employer contributions as Roth contributions, some of the top FAQs are going to include, okay, do I need a separate account for those employer contributions made as Roth contributions? And the answer is no. Both employee and employer contributions made as Roth contributions can be deposited into the same Roth Solo 401k account. What is the contribution limit? It's the same limit that applies to employer contributions generally. It's 25% of the self-employment compensation when the business is taxed as an S Corp or a C Corp. So in other words, 25% of the W-2 wages from the S Corp or the C Corp. Lastly, how do I report employer contributions made as Roth contributions on my personal or business tax return? Well, this was an open question for almost a year after Secure Act 2.0 was enacted, because prior to that, employer contributions were always made as pre-tax contributions. So they were always tax deductible. So there was an open question. Okay, well, if I'm making an employer contribution as a Roth contribution, that means it needs to be made on an after-tax basis. So how can I report that contribution as a tax deductible contribution? Well, IRS Notice 2024-2 answers that question, and it states that employer contributions made as Roth contributions are going to be reported as tax deductible on the employer's return for the year for which the contribution is made, but then reported as taxable to the employee for the year for which the contributions are deposited. All right, now let's finally turn to the voluntary after-tax limit. This is that third bucket. So the voluntary after-tax contribution limit is 100% of the self-employment compensation. Remember the W-2 wages from the business taxed as an S Corp or a C Corp, dollar for dollar up to the overall limit, $69,000 for 2024, $70,000 for 2025. Now you still need to consider the overall limit. So it's going to be reduced by any other contributions made to the solo 401k, whether employee or employer. Now it's noteworthy that the voluntary after-tax contribution limit doesn't go up if you're age 50 or older. So if you're making catch-up contributions, those contributions are not made as an after-tax contribution. Instead, they're either made as a Roth employee or a pre-tax employee. It's also noteworthy that just like the Roth contributions, voluntary after-tax contributions need to be deposited into a separate sub-account. This is why folks will end up with 3 different accounts, right? They'll have a pre-tax, a Roth, and a voluntary after-tax. Finally, just like employer contributions are not impacted by contributions made to another plan, in other words, one's ability to make voluntary after-tax contributions to the solo 401k is not reduced by the fact that they might be making contributions to another plan sponsored by an unrelated employer, like a workplace 401k plan, like a day job 401k plan. That's the general rule, right? That the voluntary after-tax limit applies at the employer level. Now, the exception to that general rule is the 403B exception, which provides that any contributions made to the 403b, whether employee or employer, together with the contributions that you want to make to the solo 401k, the sum cannot exceed the overall limit. Okay, wonderful. Now that we've laid the foundation with those contribution rules, let's start to apply it to different scenarios to see how it works as we're looking at how to supercharge my retirement, how solopreneurs can contribute to both workplace and solo 401k plans. So we'll start out with the baseline scenario. We've got a self-employed business that's taxed as an S Corp or a C Corp. Could be an LLC taxed as an S Corp or a C Corp. One participant who's under age 50 who maxes out contributions to their day job plan, right? $23,000 for 2024, $23,500 for 2025. Their goal is to first be able to maximize pre-tax contributions to the solo 401k to reduce their taxable income, and then make any additional contributions if possible as a Roth and or voluntary after-tax contributions. Finally, let's assume that they have $100,000 W-2 wages from their self-employed business taxed as an S Corp. So how much can they contribute to the solo 401k? Well, they can't make any employee contributions to the solo 401k. Why? Because that employee contribution limit applies at the employee level, and this individual has already maxed out the employee contributions to their day job plan, to their workplace plan. So they can't make any more employee contributions to the solo 401k. But the employer contribution limit, the voluntary after-tax contribution limit, is not reduced by contributions made to a day job 401k plan. So this individual can still make an employer contribution of 25% of their W-2 wages or $25,000. And since their goal is to first maximize the pre-tax contribution, they'll make that to the pre-tax account. And then they can contribute the difference up to the overall limit as a voluntary after-tax contribution, $44,000 for 2024, $45,000 for 2025. And then move the money from the voluntary after-tax account over to either their Roth solo 401k or Roth IRA. So now let's go back to the baseline assumption and change some of the factors. So same scenario, business taxes an S or a C, one participant who's under age 50, maxes out contributions to their day job plan, but now they're only interested in making Roth and or voluntary after-tax contributions. They still have that same $100,000 of W-2 wages from their self-employed business. So again, they've maxed out the employee contributions to the day job plan. The employee contribution limit applies at the employee level. They can't make any more employee contributions to the solo 401k. They're not interested in making employer pre-tax contributions. So they just simply make the entire contribution, 100% of their wages, dollar for dollar up to the limit, $69,000 for 2024, $70,000 for 2025, and then transfer either to a Roth solo 401k or Roth IRA where they've got the potential for tax-free growth. All right, now let's go back to the base. Same scenario in the sense that we've got a self-employed business taxed as an S Corp or a C Corp, one participant who's under age 50, who's over age 50, and they max out the contributions to the day job plan, right? So they make that catch-up contribution to their day job plan. $30,500 for 2024, $31,000 for 2025. Their goal is to maximize Roth and or voluntary after-tax contributions. And they have $100,000 of W-2 wages from their self-employed business, taxed as an S or a C. So again, they've maxed out the employee contributions to the day job plan. They can't make any more employee contributions to the solo 401k. They're not interested in making employer pre-tax contributions. They're only interested in making Roth and or voluntary after-tax. So they just simply make the full contribution as an after-tax contribution. So this is a great example as it illustrates a couple points, right? Number one, that you can contribute more than the overall limit between the two plans because there are unrelated employers, right? So this is a great example of how you're able to supercharge your retirement, right? So this individual is contributing, for example, over $100,000 for 2025 between their workplace day job plan and the solo 401k contributions. Number two, it's a good example of how it illustrates that the catch-up contribution limit doesn't apply to the after-tax bucket. So this individual already made their catch-up contribution to their day job plan. So they're not going to be able to make any more catch-up contributions to the solo 401k. So they just make the full $69,000 for 2024, $70,000 for 2025 to the voluntary after-tax solo 401k sub-account, then move the funds over to the Roth solo 401k or Roth IRA. All right, so now let's change the scenario. We've got two participants, but each person, let's say it's a husband and wife, both working in the same self-employed business, taxed as an S Corp or a C Corp. Each person is under age 50. Each person has a day job plan on top of it. And then each person maxes out contributions to their day job plan. Each person is not interested in making pre-tax, only Roth or voluntary after-tax. And each person receives $100,000 of W-2 wages from the self-employed business. So the limits don't change. What this is a good illustration of is that the ability to contribute applies at the person level, at the participant level. And since each person has the same scenario, right? Each person has $100,000. Each person is going to be able to contribute up to the overall limit, $69,000 for 2024, $70,000 for 2025 to that voluntary after-tax account, and then move the money over either to a Roth solo 401k or Roth IRA. So when is the deadline to make contributions? Well, as long as the plan is set up by the end of the year, you can make all types of contributions to your business tax return deadline, including any timely filed extension. And this is per IRS publication 560. But even if the plan wasn't set up by the end of the year, so let's say that you have somebody who didn't set up a plan until 2025. If you filed an extension for your self-employed business tax return, right? So in the case of an S Corp, if you filed an extension for the 1120S until September 5th, that would give you until September 15th of this year to set up a plan and still be able to make the employer and voluntary after-tax contributions for 2024. So in this scenario, right, where you've already maxed out contributions to your day job plan, you wouldn't be able to make any contributions at any rate, any employee contributions to the solo 401k, because you already maxed it out to your day job plan. But you could still set up a solo 401k for 2024, right? Assuming you were self-employed, reporting self-employment income for 2024, no full-time, non-owner, non-spouse employees working for any business owned by you or a spouse, if any, right? Assuming you're otherwise eligible, to set up a solo 401k, even if you didn't set up the plan before the end of last year, if you filed an extension for your S Corp return, you could still set up a plan, make employer or voluntary after-tax contributions for 2024 by September 15th. Likewise, if your business is taxed as a C Corp, if you didn't set up the plan by the end of last year, if you filed an extension for your 1120, that will give you until October 15th of this year to set up a plan and make employer or voluntary after-tax contributions for 2024 by October 15th. This is another good slide as it shows you how the deadline is driven by the self-employed business tax return deadline. And here's same thing except for 2025. These are the limits here. All right, wonderful. So we made it to the end of the slides. Thank you so much for participating. If you found this to be helpful, please please share with others that might be interested. There's a growing number of self-employed individuals, so it's really helpful to get the word out to others that might really value this information so they can, maximize their retirement contributions, maybe catch up on their retirement goals and secure their retirement. We also have a wealth of resources. We have our community, mysolo401k.net/my community. We have forums. We've got over 30,000 members. It's a vibrant community. So it's a great way to go and see what other people are asking about or ask your own questions. We've got the industry's first AI, solo401k.ai. It's a great resource to find answers to questions and resources quickly. Please subscribe to our different channels, whether on LinkedIn or X or YouTube, and then you'll get notifications of when we go live. Feel free to come and ask questions. So now let's go to the question. Thank you so much for patiently waiting. Thank you so much for bringing the question. Can I sell my interest in LLC owned by my solo 401k to my children? So the answer is no. you cannot sell an asset of your solo 401k to what they call a disqualified person. So the children of the solo 401k owner are going to be considered a disqualified person. It cannot be done directly or even indirectly, right? You can't sell it, in other words, to a third party and then have that person sell it to your children. So you cannot do it. Thank you for the good question, though. And thank you so much for the participation. Again, please like, please subscribe, please continue to participate. Got another question here. What is a good resource for which custodians offer which features? Loans, custody, handle alts like real estate or crypto, and how to evaluate them? Well, that's a great question. For those types of features you're looking for, such as the ability to take a 401k loan, have alternative investments, crypto, one would first need to be eligible to set up a plan like ours, and it would really need to be a fully self-directed plan like ours that's going to allow for all those features. Now, we are totally neutral as far as where the accounts are at. We help our customers, they'll open up accounts at hundreds of different banks, many different brokerages. And so even though the account might be at a brokerage like Fidelity or Schwab, it's really going to be governed by our plan documents, which allow for those different features. Now, the custodian, whether it's a bank, whether it's a brokerage, they're not going to hold the crypto. They're not going to hold the title to the real estate investment, right? The solo 401k owner as trustee will hold those investment documents for safekeeping. Now, the crypto, it would need to be either in an account on a cryptocurrency exchange, like a Gemini, for example, or it is acceptable to hold it in a private wallet where that wallet is then stored in a safety deposit box associated with, or a safety deposit box associated with an account opened up under the name and EIN number of the solo 401k. So it's possible to have both bank and brokerage accounts. And a lot of our customers will want both, right? Because they'll want a brokerage account for their traditional type investments. And they'll often find that it's helpful to have a bank account for the alternative investments, because now they get access to certified checks, debit card, the ability to ACH money easily in and out of the account, etc. I would say it comes down to service and expertise. So, for example, if you look at our reviews, we have a pristine reputation, hundreds of 5-star reviews, totally verified reviews. In other words, legitimate customers, no negative reviews. For example, on the Better Business Bureau, where there's 100% verified. And expertise. I'm one of the owners of the company. I, along with the other owner, we're very hands-on. For example, we're on these webinars. He's the one that hosts the morning webinar. We're very hands-on with our customers and all of our experience and expertise, whether over 30 years in the industry, for example, as a compliance officer that my business partner, the other owner, holds, or my background being an attorney. I'm not acting as our customer's attorney, but I do bring that experience and expertise with over 20 years as an attorney since I graduated from Harvard Law School back in 2001. So all of that experience and the pristine service reputation, I think, is one of the top reasons that customers choose us. But we definitely appreciate the chance to discuss it, and appreciate you giving us a shot and consideration. All right, well, it looks like that takes us to the end of the questions for today. Please, again, continue to participate. We appreciate all the great participation today, and we'll take it from there.